Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. There are some positive signs starting to emerge for the housing industry, and one of the companies I'm really interested to watch over the next couple of months as they report earnings is Zillow. This is a company that really plays a central role in a lot of people finding homes, doing a lot of the searching themselves, but then they make most of their money as agents try to connect with those buyers. And then there's a bunch of services that go along with the business. Now, Zillow has gone through a major transition over the last couple of years, getting out of the iBuying business. Seems like that was the right time to do it, and it actually didn't hurt the company's financials nearly as much as a lot of people thought. Is Zillow well positioned long term, especially if there's a slow but steady recovery in the housing industry and the volume that's going through the industry over the next couple of years? That's what I want to dig into today. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content and check out my newsletter, Asymmetric Investing, in the show notes. Now, I want to start with a couple of pieces of information from Zillow's most recent earnings report. This is some of Zillow's segment trends for the most recent quarter, the first quarter of 2023. These read right to left, but the change year over year is what you see on the right. Residential revenue down 14%, mortgages down 43%, other, which is a very small segment, down 27%. The positive for the business is rentals, and this is what you see right here. Rentals continue to do really well, and that makes sense, especially as fewer people can buy houses. They still need to rent housing. So that's not necessarily going to be impacted by things like higher interest rates or a slowing economy the way that the housing market is. You can see that the falling revenue also hurt all of the company's profitability metrics. Gross profit was down 15%, net income actually became a loss of $22 million, and adjusted EBITDA was $104 million. But let's look at some of the trends behind that. Now, this is residential revenue. Like I said, this is primarily from agents advertising on Zillow's platform, trying to connect with buyers of homes. Revenue is down year over year, but actually up quarter over quarter. So we're having some sort of recovery in the housing market. Now, this is not necessarily going to be a consistent recovery or a V-shaped recovery, but I think it is pretty clear that interest rates are not rising at the rate that they were in 2022, and that should be good for housing long term. We see some similar numbers when you look at mortgages and purchase loan origination volume. Both of those segments are improving month over month. The loan origination volume is a newer business and is starting to improve more even on a year over year basis. If we go back to the rental revenue numbers, you can see here just slow but steady growth. This is what you like to see from a business like Zillow's. So what's the reason to be optimistic about Zillow's future? One reason to be optimistic is mortgage rates. You can see here that mortgage rates have basically stabilized since fall of 2022. That means that mortgages aren't necessarily getting more expensive quickly on a month over month basis. Remember, the monthly payment that buyers are actually paying for a home is dependent on not only the purchase price of the asset that they're buying, the home, but also the interest rate that they're paying. So the faster interest rates go up, the faster that monthly payment goes up. And that just, the impact that it ends up having is it slows down the market. Typically, home values don't go down at a commensurate rate with the rise in interest rates. Housing is just too sticky. Sellers are stuck on the value that they think that they have in their home. And so if they're not going to get that value from buyers, they're just going to pull it off the market. That's typically what happens in housing. But you can see here that rates have been at least steady. So we should see some of the slowdown in the market at least thaw. So what's the reason for the slowing down of the rise in interest rates? This is the data right here. And this is inflation and unemployment. Unemployment is the purple line. Inflation is the orange line. Unemployment has remained relatively low. And actually the economy has done pretty well, at least in the US. And that's driving incomes higher. It's driving that purchasing power higher. So that's really helping. And then the inflation rate has also come down dramatically, basically back to a normal level of inflation. And what that's going to do is cause the Federal Reserve to maybe not increase interest rates as much as they were planning to previously. They have said that they'll probably increase rates at least once more throughout 2023, but we're not going to have the same increases that we had last year. So I think the fear about the rise in interest rates is probably past us, both from a buyer standpoint and from just an overall economy standpoint. So these things As these work their way through the system, this should be a tailwind for Zillow. I think at the end of the day, the worst of the business environment is behind us. And Zillow is in a phenomenal position because it's a nationwide company that's a two-sided market that has both buyers and sellers, whether you're talking about a direct seller or an agent that is selling through Zillow. They both need a platform to reach each other. Zillow has become that. And it's really the only company that has the kind of scale that it does, has the kind of data to create things like Zestimates. Maybe not the best way to price a home, but at least gives you an idea what a home is worth. And long term, if we start to see the housing market recover, both from a valuation standpoint, but also from a volume standpoint, remember, most of the people that are paying Zillow, those agents, they want to see increased volume. They don't necessarily need to see the value of homes rise 5 to 10% a year. But if volumes drop, then their income drops. So that's where the incentive lies for them. So if the housing market starts to thaw, more homes are selling. That means the agents are making more money. That means that they can spend more money on Zillow to advertise their properties. That's the way that this business works. And I think we're past the worst. Zillow's run rate is still about $100 million of EBITDA per quarter. I think there's a lot of operating leverage to improve that over time if the market recovers. The company has cut a lot of costs. So long term, I'm really optimistic about where Zillow is sitting. I would like to get in a little bit better valuation. Somewhere around 40 times EBITDA just for the stock is not a real cheap valuation for investors. But I think operationally, this could be a company that is able to grow the bottom line and cash flow much quicker than it's able to grow revenue if there is a significant increase in revenue over the next few years. So that's the way that I'm looking at this stock. What do you think? Is this a way that you would play the improvement in the housing market? Love to hear your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.